David was 52 years old when he watched nearly $187,000 disappear from his retirement account in less than 6 months. He had done everything people told him to do, worked hard, contributed to his 401k, bought index funds, trusted the market, and believed that if he stayed patient, everything would work out. But one morning, sitting at his kitchen table in Ohio, with a cup of coffee in his hand, he opened his portfolio and realized something terrifying. The market wasn't correcting, it was unraveling. Stocks were falling, headlines were panicking, analysts were changing their tone overnight. And David kept asking himself one question: why didn't anyone warn me sooner? The truth is, the warning signs were there. They were flashing in plain sight. Most people just ignored them. Now listen carefully. Forget what's happening around you. Ignore whatever is on your screen. For the next few minutes, I need your full attention on my voice, because the signals I'm about to show you are the same signals that have appeared before nearly every major stock market crash in modern history. And if you understand them early, you may be able to prepare before the crowd panics. The first stock market crash signal flashing right now is extreme market valuation. In simple terms, stocks may be priced far above what the underlying businesses are actually worth. When investors become too optimistic, they start paying absurd prices for future growth. This creates bubbles, and bubbles always feel normal right before they burst. Historically, when valuation metrics rise far above long-term averages, future returns often weaken dramatically. That doesn't guarantee a crash tomorrow, but it does mean the market is becoming fragile. Think of it like a tower built too high on a weak foundation. It may stand for a while, until one shock knocks it down. The most dangerous part about overvaluation is that rising prices make investors feel safer, when in reality, the opposite is often true. The higher prices climb without fundamentals supporting them, the more painful the eventual correction tends to be. That's because when expectations become unrealistic, even slightly disappointing news can trigger massive sell-offs. Investors who once justified every rally suddenly begin questioning every valuation, and when that sentiment changes, it changes fast. The second warning sign is persistent high interest rates. For years, markets benefited from cheap money. Borrowing was easy. Companies could take on debt, buy back shares, and fuel growth. Consumers could spend more freely. But when interest rates stay elevated, everything changes. Mortgages become more expensive. Credit card debt becomes heavier. Business loans cost more. Corporate profits get squeezed. And the same economy that once looked strong starts slowing beneath the surface. High rates rarely break things overnight. Instead, they create pressure gradually, month after month, quarter after quarter, until the system begins to crack. Investors often ignore this because the damage is delayed, but delayed damage is still damage. Every major tightening cycle eventually exposes weakness somewhere in the system. Sometimes it's housing, sometimes it's corporate debt, sometimes it's banking. But something almost always breaks when money stays expensive long enough. The third signal is something average investors often miss. Smart money is getting defensive, while retail investors are still buying hype and chasing momentum. Many institutional investors quietly rotate into safer assets. They reduce exposure to risky growth stocks, increase cash positions, and move into bonds, dividend stocks, gold, and defensive sectors. Why? Because professional money managers don't wait for the crash to begin. They prepare before headlines confirm anything. By the time the average person hears recession fears on mainstream media, smart money has often already repositioned. The wealthiest investors understand that by the time panic becomes obvious, the opportunity to prepare is usually gone. Institutions study capital flows, insider selling, bond market behavior, and macroeconomic trends constantly. They don't rely on social media hype or emotional narratives. They follow data, and when the data changes, so does their positioning. The fourth and final signal may be the most dangerous. Consumer weakness beneath the surface. On paper, the economy may still look fine. Employment numbers may seem healthy. GDP might appear stable. But beneath those headlines, cracks can form quickly. Credit card balances rise, savings rates fall, delinquencies increase. Households begin struggling quietly before the official recession data catches up. And when consumers pull back spending in a consumer-driven economy like the United States, corporate earnings start collapsing. Once earnings fall, stock prices often follow. Economic weakness usually starts silently small, signs at first before turning into something impossible to ignore. Consumers don't wake up one morning and stop spending entirely. Instead, they cut little things first. Fewer dinners out, smaller vacations, delayed purchases, less discretionary spending. Businesses feel it gradually until suddenly revenue misses become widespread. Here's what makes this moment especially dangerous. Many investors assume that because the market has recovered from every past crash, it will automatically recover quickly from the next one. But that mindset creates complacency. People forget that some recoveries take years, sometimes even a decade. If someone is close to retirement or needs access to their capital, just wait it out is not always a simple strategy. Long-term investing works best when you actually have the time to wait long-term. Many people don't realize that until it's too late. A 25-year-old can survive a brutal downturn much differently than someone approaching retirement. Risk tolerance is not just emotional, it is mathematical and practical. Now, let me be clear, seeing these warning signs does not guarantee a crash tomorrow. Markets can stay overvalued longer than many expect. Fear can fade temporarily. Optimism can return. But experienced investors understand something important. Successful investing is not just about maximizing gains, it's about managing downside risk when warning signs increase. Protecting capital matters, because if your portfolio falls 50%, you don't need a 50% gain to recover, you need a 100% gain. Large losses create mathematical damage that can take years to repair. This is why the best investors in the world focus as much on defense as offense. They know survival is the foundation of long-term compounding. So what should investors be thinking about when these signals appear? First, reassess your exposure. Many people don't realize how concentrated their portfolios have become after long bull markets. A portfolio that looked diversified 3 years ago may now be heavily dependent on just a few megacap stocks. If those few names fall together, diversification disappears instantly. Second, understand your time horizon. A 22-year-old investor and a 62-year-old investor should not react the same way to market risk. Third, build a plan before panic begins, because once markets start falling hard, emotions take over, and emotional decisions are often expensive decisions. Panic selling near bottoms has destroyed more wealth than crashes themselves. The reality is that crashes rarely come out of nowhere. They feel sudden in hindsight, but the signals usually build 4 months in advance. Overvaluation, tight monetary policy, defensive institutional positioning, weakening consumers. These patterns have appeared repeatedly throughout financial history, not because history repeats perfectly, but because human psychology repeats perfectly. Greed, denial, euphoria, panic. Every cycle follows the same emotional script. Even if the details change, human nature has not evolved past fear and greed. And markets continue reflecting those emotions every single cycle. And that's why the biggest financial losses often happen not because people lacked information, but because they ignored uncomfortable information. They heard the warnings and said, "This time is different." They convinced themselves the market would keep climbing forever. They believed the dip was always temporary until it wasn't. Every major crash in history was preceded by people claiming the old rules no longer applied, and every time, reality eventually proved otherwise. It happened during the dot-com bubble. It happened during the housing bubble. It happened during countless speculative manias before that. The names change, the assets change, the story changes, but the psychology never does. Imagine being the person who sees the storm before everyone else, while others are laughing, buying the top, and celebrating new highs. You're quietly preparing, not panicking, not fear-mongering, just positioning intelligently, because wealth is not built only by making money in bull markets. Wealth is protected by avoiding catastrophic mistakes in bad markets. That's what separates disciplined investors from emotional ones. Emotional investors assume recent performance predicts future returns. Disciplined investors know that the best opportunities often appear when fear is highest, and the greatest risks often appear when confidence feels strongest. So if you're hearing more analysts suddenly talking about risk, if insiders are selling, if defensive assets are strengthening, if economic cracks are growing while markets stay euphoric, don't ignore it. Pay attention, because markets often look strongest right before they become weakest. Tops rarely feel dangerous while they're happening. They feel exciting. They feel obvious. They feel unstoppable. That's why so many people get trapped at them. Nobody rings a bell at the top. There is no official announcement that says, the bull market is over. The market simply begins falling when the crowd least expects it. David learned that lesson the hard way. After losing nearly $200,000 in the downturn, he said something that stuck with me. I wasn't afraid because I didn't think it could happen. I was afraid because I realized. I saw the signs and chose not to act. Don't let that be your story. The market may continue higher from here, or it may not. No one can predict the exact day of a crash. But smart investors don't need perfect predictions, they need awareness, discipline, and preparation. Because when warning signals flash, ignoring them can be costly. So ask yourself honestly, if the market dropped 20%, 30%, or even 40% from here, would your portfolio survive? Would your strategy survive? Would your emotions survive? If you're not sure, then maybe the most important thing you can do today is not chase more upside, but prepare for downside. Because the investors who survive crashes aren't the ones who panic first. They're the ones who prepared before panic began. And preparation doesn't necessarily mean selling everything. It means understanding your risk. It means knowing what you own and why you own it. It means having cash reserves, realistic expectations, and emotional discipline. It means recognizing that investing is not about proving you're right, it's about staying in the game long enough to compound wealth over decades. Many investors destroy themselves trying to maximize every rally while ignoring the possibility of serious downside. They think risk management is unnecessary until the day they desperately need it. If these 4 stock market crash signals continue flashing, the next major market move may catch millions of investors completely off guard, not because the evidence wasn't there, but because most people refuse to look at it. That's what always happens near major turning points. The signals are visible, but optimism blinds people to them. Comfort makes them complacent. Success makes them careless. And then reality arrives all at once. Stay alert. Stay rational. Respect risk even when others ignore it. Because markets reward discipline and punish complacency. They humble the arrogant, expose the reckless, and test the patience of everyone involved. And never assume the crowd will warn you before it's too late. Because by the time the crowd notices the danger, the smart money is already gone. So the question isn't whether another crash will eventually happen. It will. The question is whether you'll recognize the signals before it does. Because the investors who build lasting wealth aren't the ones who predict every market move perfectly. They're the ones who survive long enough to keep playing the game. And survival in investing has always depended on one thing above all else: respecting risk before the crowd is forced to. Disclaimer: this video is for educational and informational purposes only and should not be considered financial advice. I am not a licensed financial advisor, and all investing involves risk, including the possible loss of principal. Always do your own research and consult with a qualified financial professional before making any investment decisions.